Markets have been sending strong signals recently, indicating shifting expectations for Fed policy and its broader impact across asset classes and fiscal dynamics. Today, we'll explore what that means for policy, why long-term yields matter, the push and pull between valuations and earnings, and the fiscal risks that could shape the outlook. I'm Johanna Bota, and joining us today is StoneX's Managing Director and Chief Market Strategist, Kathryn Rooney Vera. Welcome, Kathryn. Lovely to have you with us.
Thank you so much, Johanna. Pleasure to be with you.
So I want to start with what we're seeing in the markets. The dollar's weaker, gold is rallying, yields are easing, signs that the Fed could be near neutral. What does that tell us about how investors are reading the Fed's priorities right now?
Yeah, you're right, Johanna. The markets are signaling the Fed is close to neutral, the neutral rate, which is the rate at which a monetary policy is neither inflationary nor deflationary. The dollar is down 10% year to date. Gold is up a whopping 45% year to date. And Treasury yields recently have eased. So investors are telling us the Fed is going to prioritize here in the United States jobs, even if inflation, Joanna, stays above 2%. So that aligns, when you look at the Fed's dot plot, it aligns with the Fed's own dot plot, which points to three cuts in 2025. So the Powell said the dot plot should be viewed in probabilistic rather than binary terms, which we interpret on our team to mean that Chair Powell sees the odds of two additional cuts. So we're talking October and December of over 50%. So bottom line here, Johanna, is that the Fed is leaning dovish, defending labor stability while keeping an eye on inflation, but the labor market has taken priority.
So also, when we look at the 10-year, yields are being shaped by both short rate expectations and the term premium. How much are today's fiscal risks and supply decisions influencing that balance?
Yeah, you're right. You're right. The 10-year reflects generally two things. As you said, the investors expect the Fed to do, and the term premium, which is the extra yield investors require to hold long-term bonds. That premium finally turned positive this year because of our massive fiscal deficits, which are now we're approaching 7% of GDP, which is enormous for an economy not in recession, with no crisis at the moment, and growing above potential, okay? And it's likely to stay higher. The term premium is likely to stay higher in past cycles because of this reason. Recently, though, we've seen Treasury supply decisions and expectations of Fed cuts pushing yields lower. So the 10-year yield has of late come down. The Treasury kept auction sizes steady and expanded buybacks. So that eases near-term pressure. And I'll add one thing, which is very interesting and different from much of what we economists anticipated. But tariff revenues are running enormous. We're talking $500 billion annualized, according to Secretary Bessent. That helps reduce borrowing needs. Yeah, so it's actually very good. So that's helped the bond market in the short run. But if tariffs prove more lasting, it could mean higher prices. And the fact of the matter, Joanna, is, as we know as economists, that near-term jump in revenues is generally temporary because people substitute.
We've actually heard that policy is described as only mildly restrictive with little cushion left. Does that mean that the Fed stays on slow and steady path unless the labor market really weakens, which you kind of touched on that a little bit earlier?
Yeah, that's the biggest question. You're totally right. So recently, the president of the Cleveland Fed said that current Fed policy, which is above 4%, is only mildly restrictive and near neutral. Near neutral means that, the Fed has very little room to drastically cut rates. So that means very little margin without risking inflation or stoking excess risk taking, which is what we're seeing right now in the markets. The equity markets are just going gangbusters. Meanwhile, inflation is above the 2% target, and the Fed has emphasized that it expects inflation to remain persistent. So it seems that there are several members of the Federal Reserve Committee that think that the Fed can't cut too much further. And that plays out in financial conditions, because when you look at financial conditions, Johanna, The Chicago Fed's National Financial Condition Index suggests to us that financial conditions here in the US and my country are about as easy as they were for much of the 2000s, the early 2000s. So financial conditions are easy. So that means that the monetary policy rate currently is not too restrictive. So that means that there's a very good chance the Fed can't cut too drastically without igniting or reigniting inflation.
That's right. I mean, it's a tricky balance, right? Because
Yeah,
valuations are stretched, but earnings
right,
keep beating expectations. So, how do
right.
you see that push and pull playing out for US equities and around the world?
Yeah, valuations are extended when you look. So I follow something called standard deviations, how many standard deviations we are from the mean. Yes, we're extended. We're not beyond hope. So, yes, things look rich. And I think that high valuations, markets don't die from old age. That's a fallacy. That's an adage that's incorrect. So markets decline when there's a shock. It can be labor market, it can be fiscal, it can be geopolitical. When that undermines the foundation, when that undermines, as you mentioned correctly, earnings, and earnings are strong. So markets don't die of old age. Earning strength has kept markets supported so far. Regardless of Liberation Day, regardless of anything else, the markets are strong. The Fed's own projections show stronger economic growth this year. Employment's still pretty good, and temporary tariff effects. So I guess my point here is that if those assumptions fail, meaning inflation is relatively range bound, economic growth remains strong, and tariff effect is very minute, then valuations will prove vulnerable, and that could cause a correction.
What about government shutdowns? Because they don't usually spark recessions, but today's fiscal backdrop is a little and feels a bit different. How could this risk affect markets, and might it push the Fed to ease a little bit faster than they have been?
Yeah, government shutdowns are a very common thing here in the United States. They usually dent sentiment in a very, very flash in the pan type of way. They do not cause recession. Since 1981, actually, half of government shutdowns have lined up with about a 5% drawdown in the S&P. What makes me think differently about this case? Usually it's a yawner, to be honest with you. But in this case, I care a little bit more. And the reason I care, especially as previously an emerging markets analyst, is that I look at something called the interest coverage ratio. I look at debt servicing costs, and those are rising here in the United States. Coverage ratios are weakening, and treasuries don't hedge portfolios like they used to. You know, the 60/40 has broken down. So, yes, tariff revenues are helping. That's great, but they don't offset the confidence and labor hit of a prolonged slowdown could cause. So, if furloughs, if permanent firings actually occur, labor data deteriorates, and Powell, who is more sensitive to to the employment picture than inflation, he could be pushed to ease more aggressively. So these are the concerns that I'm looking at with regard to the shutdown.
Kathryn, thank you so much for your time. And thank you to our viewers for watching. For more financial content, don't forget to like and subscribe to our channel.